The Fed has finally admitted that we could be going into a mild recession sometime by the end of this year, but stocks only go up. We had good bank earnings this week. We had 2 low inflation readings with CPI and PPI, and big tech is trading at higher multiples last year whenever we had earnings growth, when we know that we're going to have an earnings recession by the end of this year. The stock market had yet another green week after all of this good inflation data and good bank earnings. So how do we get here? Starting with the news on Monday, we got some more China-Taiwan drama with 26 planes and 9 ships going through the Taiwan Strait. And pretty much every Western country was denouncing this, saying that we shouldn't escalate the situation. But China is deciding to do combat trading in the Taiwan Strait. So they're ramping up their efforts in preparing for war with Taiwan. And this seems to be the trend over the last couple of weeks since China's Xi ended up meeting with Putin in Russia. Now, whether it's just a coincidence or not, I don't know, but it does seem like there is more efforts from China to go to war with Taiwan. And this put a lot of pressure on stocks on Monday, but they ended up recovering by the end of the day. On Tuesday, we had Bitcoin finally breaching the $30,000 mark, and the IMF, or the International Monetary Fund, forecasted only 1.3% growth for the world this year and an inflation rate of 7% for the world economy. So basically what the IMF is telling us here is that we're going to have slow growth in the economy, but we're still going to have sticky inflation. So basically IMF is admitting that we're going to have stagflation for 2023. Surprisingly though, on Wednesday, we got a cool CPI report coming in at just 5% year over year versus 5.1% expected. And this is down from 6% in February. So this was a really good reading compared to last month. And the month over month reading came in at positive 0.1% versus 0.2% expected and 0.4% for February. And then the core CPI was still sticky, coming in at 5.6% year over year versus 5.6% expected. And this is actually up from 5.5% in February, where the month-over-month reading was 0.4% this month versus 0.5% last month and 0.4% expected. So it came in at expectations, slightly lower than last month, but the year-over-year reading was slightly higher, leading us to believe that core inflation is here to stay. So this means that the odds for pausing for the May FOMC meeting is about 20% as of right now, with the core CPI coming in hotter than expected. And then Buffett made some comments on the bank failures over the last couple of months, saying that there's probably more bank failures to come, but he's willing to bet that no depositors will lose any money. So if there's more bank failures to come and we have one of those banks fail in the near future, then we could see some more volatility, just like we did around Silicon Valley Bank. But we do know that the Fed and the Treasury is willing to bail them out, no matter the size of the bank. On Thursday, we had PPI coming in at 2.7% year over year, which was expected at 3%, and this is down from 4.9% in February. So this was a huge drop in the year over year inflation from February to March. And then we had negative 0.5% month over month versus negative 0.1% expected. And this is down from 0% as of February. So a huge drop in the producer price index, meaning that producers are paying less in order to order their goods to sell to us. So hopefully they pass down those savings, but we all know corporate America, probably not. And the core PPI came in at 3.4% versus 3.4% expected, and this is down from 4.8% in February. So a significant decline in the core PPI reading. And then the month over month rating came in at negative 0.1% versus 0.2% expected. And this was 0.3% in February. So a decline in both the month over month reading and the year over year reading for the core PPI. Also on Thursday, we had the initial jobless claims coming in at 239,000 versus 232,000 expected. And this is up from 228,000 people that filed for unemployment last week. So the initial jobless claims was higher than it was expected and higher than last week, but the continuing jobless claims somehow managed to be relatively neutral. And then Delta Airlines ended up missing on their earnings report. They fell by 0.2% this week, so hardly at all, after they ended up missing their earnings and beating their revenue, but they told us that they have a good summer ahead. Usually the summer has more travel, but I think that the year-over-year comparisons could be a little bit dodgy, so we'll have to see for the next quarter what Delta Airlines can come up with. And then Friday, we had big bank earnings. JP Morgan ended up going up by 9.6% this week after a huge beat in their earnings per share, and they forecasted $81 billion in net interest income. And the reason why they're making all of this money is because the Fed is paying them 4.75 to 5% for their overnight funds. Meanwhile, they're only paying their customers 0.01% interest. So they get to take advantage of taking in the money, getting 5% interest, and then only giving 0.01% interest away. That's a monopoly at work for you. Take all the money out of the small banks and then put it into the big banks where you're not going to get any interest on it. Welcome to America. Retail sales ended up coming in lower at 2.94% year over year versus 5.4% expected. And this is down from 5.88% year over year in February. And the month over month reading came in negative 1% versus negative 0.4% expected, down from negative 0.2% last month. So a significant decline in retail sales for the last couple of months, which is leading us to believe that we could be in a recession already since there's less demand in the economy and people are spending less money. Core retail sales also came in negative 0.8% versus negative 0.3% expected, and this is down from 0% as of last month. But what's interesting is the same day on Friday, we got the Michigan Economic Report where basically all of the indicators were showing us that the consumer is expecting a pretty positive economy right now and in the near future in the next year. But the Michigan inflation expectations came in at 4.6% versus 3.5% expected, and this is up from 3.5% last month. That was a huge increase in the inflation expectations for this month, so we'll see if that plays out. Usually inflation expectations has a psychological effect where if the consumer expects prices to go up in the future, they're going to start buying things now, creating more demand, where prices go up if the supply can't keep up with the new demand. So that's what happened this week, and then our outlook for next week, we have the New York Empire State Manufacturing Index on Monday at 8:30 in the morning, expected to come in at negative 18 versus negative 24.6. We all know that manufacturing has been taking a hit pretty much since June of last year. And then also on Monday, we're going to have Schwab earnings in the morning. Charles Schwab was one of the biggest hit banks in the SVB mess, so definitely watch out for this one this week. And then on Tuesday, we had Fed Bowman speaking at 1 p.m., as well as Bank of America earnings, Johnson & Johnson, Goldman Sachs, Lockheed Martin, Netflix, as well as United Airlines. So a lot of earnings coming out on Tuesday. And then the big earnings of the week is going to be Tesla on Wednesday after hours, as well as Fed Williams speaking at 7 p.m. on Wednesday. And then Thursday, we're going to have the initial jobless claims coming out at 8:30 in the morning, which is expected at 240,000 versus 239,000 last week. So be watching out for this, because if this initial jobless claims continues to come in higher and higher, more people are getting laid off. Demand is going to slow down because people don't have jobs to pay for anything. And the continuing jobless claims is expected to come in at 1823,000 versus 1810,000 as of last week. Also on Thursday, we're going to get the Philly Fed Manufacturing Index at 8:30 in the morning, which is expected to come in at negative 20 versus negative 23.2 as of last month. Fed Waller is going to be speaking at 12 p.m. on Thursday, and then we're going to have a few earnings for Thursday. TSMC, or Taiwan Semiconductor Manufacturing Corporation, AXP, or American Express, and then we're going to have AT&T all reporting on Thursday. And on Friday, you're going to get the S&P Global Composite PMI coming in at 9:45 in the morning, where the manufacturing PMI is expected to come in at 49 versus 49.2 as of last month, and then the services PMI is expected to pull back to 51.5 versus 52.6 as of last month. We're going to need to watch out for this, especially with the global composite PMI and what the statement from the S&P is. And then services we need to pay attention to because we still have services inflation. So ideally, we want the reading to come in lower than expected so we don't have as much inflation in services. So those are all the macro events for this week. And then SPY with a technical analysis, you're expected to be in a range of about $6 in either direction. So we're expected to be between 406, 408.50 and 412.50, with supports at 412.30, 410, and 406. And resistance is going to be at 416 and 418.21. The main events to watch for this week are going to be the ones that are bolded up here: initial jobless claims, S&P Global Composite PMI, services inflation. So those are going to be the most volatile. And then you're going to need to watch out for Netflix and Tesla earnings, because big tech has been leading the rally year to date. So if big tech can't live up to the hype of the rally and their earnings reports, then we could see a significant pullback for the big tech, which would end up pulling back S&P and especially QQQ. And speaking of earnings, we're going to have Goldman Sachs reporting on Tuesday in the pre-market, where their earnings is expected at 90 cents. They did 332 as of last quarter and 1076 a year ago, so they're expected to see a 90% decline of their earnings per share. And historically, they've done an average of 11.18 earnings per share over the last 2 years per quarter. The revenue is expected to come in at $5.21 billion versus $10.91 billion as of last quarter. So a 50% decline in their revenue quarter over quarter. And last year they were doing $11.76 billion in revenue. And historically, over the last 8 quarters, they've done $13.34 billion in revenue per quarter. The expected range for their stock is $14 in either direction, so we're expected to be between $323 and $351, with support levels at $332.94, $326, and $320, with resistance at $338.17, $344.53, $350, and $357.50. If they end up beating their earnings per share expected at 90 cents and then beating their revenue at $5.21 billion, then I think their stock will be above $350. If they beat earnings, miss revenue, I think their stock will be above $345. If they miss earnings but beat revenue, I think their stock will be above $335. And then if they miss earnings, miss revenue, I think their stock could sink below $325 by the end of the week. And then for Netflix, they're reporting Tuesday after hours, with their earnings per share expected at $2.81 versus just 12 cents as of last quarter and $3.53 a year ago. And over the last 8 quarters, they've done an average of $2.65 earnings per share. The revenue is expected to come in at $8.17 billion versus $7.85 billion last quarter and $7.87 billion a year ago. And historically, over the last 8 quarters, they've done an average of $7.66 billion in revenue. The expected range is $30 in either direction, so they're expected to be between $309 and $369, with support levels at $335.30, $322, and $303.39, as well as resistance at $350.50, $361, and $370. If they end up beating their earnings per share and missing their revenue, I expect their stock to be above $350. If they beat earnings and miss revenue, I expect their stock to be above $335. If they miss earnings for this quarter and then beat revenue, I think their stock could stay above $320. And if they miss earnings, miss revenue, we could be sinking below $315 for Netflix. And then finally, Wednesday after hours, Tesla is reporting earnings, which is expected to come in at 85 cents versus 119 as of last quarter and 95 cents a year ago. And historically, they've done an average of 74-cent earnings per share over the last 8 quarters. The revenue is expected to come in at $23.37 billion versus $24.32 billion last quarter, $17.72 billion a year ago, and historically they've done an average of $16.9 billion in revenue over the last 8 quarters. Their expected range is $16 in either direction, so they're expected to be between $169 and $201, with support levels at $177.50, $165, and then resistance at $188.04, $201, and $212. If they end up beating their earnings and then beating their revenue, their stock could be above $195. If they beat earnings, miss revenue, their stock could be above $190. If they miss earnings, beat revenue, I think their stock could be above $180. And then if they miss earnings, miss revenue for this quarter, their stock could be sinking below $175. So if we have worst case scenario for Netflix and Tesla this week, I definitely could see QQQ seeing a significant pullback, especially considering we're trading at the top of the range. But if they can do well on earnings, where they end up beating their earnings per share estimates, then we might see QQQ propped up at that 320 level. So definitely be watching out for these names and earnings this week. Hopefully this video was helpful. If it was, show some love, leave a like. Thanks for making it all the way to the end of this video, and thank you to all my patrons and my channel members for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.